All right, let's dive into the world of Warren Buffett.
Yeah.
In this deep dive, we're going way beyond those typical headlines and getting right into his investment philosophy. I think a lot of our listeners want to get a better grasp on Buffett's whole approach to business.
Yeah, definitely.
And to do that, we're going straight to the source, right?
That's right.
His
This
letters
is straight to the source.
to Berkshire Hathaway shareholders spanning decades, actually,
Yeah, exactly.
from 1965 all the way to 2019.
That's a lot of letters.
It is a lot of letters. So we've got a lot to cover.
Yeah, we do. So this is going to be great, though.
Yeah. So these letters, for our listeners, they're not just some boring financial reports.
Right.
Right. They offer a really unique perspective into how Buffett thinks, how his strategy has evolved over such a long period of time, how many decades,
Decades, yeah.
and what lessons we can actually take away from his wild journey with Berkshire Hathaway.
It's wild, yeah. It's remarkable, to see how consistent he's been over time.
Yeah. Yeah. So for you listening, you can think of this deep dive as kind of like having a personal guide, walking you through all of Buffett's wisdom,
Absolutely.
distilled from years and years and years of market experience.
Exactly.
And it's all from his perspective.
Yeah.
So why don't we start at the foundation? Let's talk about Buffett's investment philosophy.
Yeah, let's do it.
One thing that just jumps out from reading through all these letters
Yeah.
is his remarkable consistency, right?
Yeah.
I mean, his core principles, they've basically stayed the same for decades.
Yeah, like remarkably steady. You can pick up a letter from the 60s, and it
Yeah.
pretty much sounds like a letter from today.
It's impressive considering how much the market has changed in that time, right?
Mm-hmm.
I mean, the world in general.
It's totally different. He's weathered all these different storms, all these different trends,
Yeah.
and he's like, nope, sticking to my guns. This is what I believe in.
Yeah. So what are these kind of, golden rules that have guided him through all these ups and downs?
Yeah. I think first and foremost, it's this focus on intrinsic value. He's not out there looking for a quick buck, like a quick flip or the trendy stock of the day. He wants to own, I guess you could say, like slices.
Pieces.
Yeah,
Yeah.
of great businesses
Yeah.
with these durable competitive advantages.
A moat.
A moat, yeah, that can protect their profits over a long period of time.
Yeah. It's like he's saying, forget the hype, show me the substance,
Yeah.
show me the real business.
Yeah,
And that leads us to another kind of key concept, right? Margin of safety.
exact.
He insists on buying these great businesses, but at a price that's significantly below
Yeah.
that intrinsic value.
I mean, you shouldn't just buy something because it's popular, right? You need to understand what it's actually worth and look for that bargain.
It's like being a smart shopper,
Exactly.
even in the stock market.
Be a value investor.
Yeah, don't overpay. Even if it's a great company, right? You
Yeah.
want that cushion.
Right, yeah. It's protection, right? Like
Yeah.
if things don't go exactly as planned.
Right. Yeah. And closely tied to that is his really long-term perspective,
Absolutely.
right? Like he's always encouraging people to basically ignore
The day-to-day.
the noise,
The noise.
the market noise,
Ignore it. Don't even look at it.
focus on the business.
Business, yeah.
Right. And like its health, is it growing over the long term? He's thinking in terms of decades, not quarters.
It's wild. It's so counter to how most people on Wall Street,
Yeah,
or even, just in general, think about the market.
totally. And there's this interesting concept. I've never really thought about it before. This investor's misery index.
Yeah, the misery index.
Can you explain what that is and how it connects to that long-term approach?
Yeah, so the misery index, it combines, the inflation rate with the percentage of your capital that basically gets eaten away by taxes when you eventually go to turn those investment gains into cash.
Ah,
So it's a reminder, right? Over these really long periods of time,
yeah.
inflation and taxes can really significantly eat into your return. So you have to factor that in. So you got to be thinking about ways to kind of outpace those things
Yeah.
over years,
Yeah.
not just months.
Yeah, like a long-term game.
Exactly.
Yeah. It's like he's saying, don't let those silent thieves of inflation and taxes,
Yeah.
steal all your future gains.
Exactly. I mean, he's very aware of those things.
Yeah.
And he's always thinking about how to stay ahead of them.
Totally. Now, another key principle that he talks about a lot is this disdain for complexity.
Yeah, absolutely.
He really favors these straightforward, easy to understand businesses, right?
Yeah.
with those proven management teams already kind of in place.
Yeah.
So he's not interested in going in and trying to, fix a broken company or betting on like unproven ideas.
Right. He wants like a well-oiled machine
Yeah.
that he can step into
Yeah.
and it's already humming along, right?
Already humming along, already making money. It's just a matter of like letting those profits keep flowing.
Yeah. And he's got a great eye for that.
Yeah. And this preference for simplicity,
Yeah.
it probably connects to another aspect, right?
Yeah.
Which is shareholder alignment,
Yeah, for sure.
which we know is huge for him.
Yeah, absolutely.
Making sure that everyone is kind of incentivized to work
page.
in the same direction.
Yeah.
Yeah. So we've got these big pillars.
Right.
We've got intrinsic value, margin of safety, long-term perspective,
Yeah.
simplicity, shareholder alignment.
Yeah.
Those are pretty solid pillars to build a whole investment strategy on.
Yeah, I'd say so.
But there's something else that's central to Berkshire Hathaway's success,
Absolutely.
and that's the power of float.
Right.
Right.
This is where it gets really interesting, right?
Yeah. And I think a lot of our listeners, they may have heard this term.
Yeah.
They may not fully understand it. So can we break that down
Yeah, let's do it.
a little bit?
Absolutely. So Buffett, he loves insurance businesses.
Yeah.
And the reason is they provide what's called float. And, it's basically the money that these insurance companies, Berkshire's insurance companies, collect upfront as premiums,
Right.
but they don't actually have to pay out until later
Yeah.
when the claims are actually made
Yeah. So it's like having this huge pool of money just sitting there
that you can invest.
to invest with
Yeah.
while you're waiting for all those claims to come in. So that seems like, on the one hand, a huge advantage,
It is. It is a huge advantage.
but it also sounds pretty risky.
Oh, yeah, of course.
Yeah.
If you're not careful, that float can disappear really quickly.
Right.
But that's where Buffett's legendary underwriting discipline comes in,
Okay.
right? He only writes these policies when he's confident that the premiums are more than enough to cover the risk.
Okay.
He wants that float to be as low cost as possible, ideally even negative cost.
Okay.
He's not going to lose money on the insurance just to get his hands on the float.
So it's not just collecting as many premiums as possible. It's
Yeah.
making sure
Yeah. Yeah, that's the key, right?
that those premiums are properly
Right.
covering those potential claims
Yeah.
and still leaving some room for profit.
Exactly. Yeah. You got to be really careful
Yeah.
about, how you're pricing those policies and making sure that you're selecting the right kind of risks
Yeah.
that fit within your overall strategy.
Right. So it's not just like setting up lemonade stand and trying to sell as much lemonade as possible.
Yeah,
It's like making sure you can actually buy the lemons.
exactly. Exactly. You got to know your costs.
Yeah.
You got to manage your costs very carefully.
Right. Yeah. And so this low-cost float that he's created
Yeah.
is a key driver
Huge driver.
of Berkshire Hathaway's insane returns, right?
Oh, yeah, absolutely. I mean, this is one of the secret weapons, if you will,
Yeah.
of Berkshire. It's allowed them to basically invest on a scale
Yeah.
that most other companies can only dream of.
Right, because they've got this pool of money that they can use. Yeah. So it's a huge advantage, but it's also a testament to his discipline.
It is.
Yeah.
Yeah. You got to be really, really, really good at underwriting to be able to pull this off.
Totally. So now we've laid the groundwork. We've talked about his core investment philosophy, the float.
Yeah.
Now let's get into the specifics, right? Like to really understand this approach, I think we need to see it in action.
Yeah.
In actual businesses, right? So what are some of the companies that really stand out
Yeah.
as like examples of this style
Yeah. Let's get into some examples.
and really contributed to their overall success?
Yeah, for sure. So let's talk about See's Candies.
Okay.
This is one of Buffett's all-time favorites. He bought it way back in 1972
Yeah.
for $25 million. And by 1999, this little chocolate company had earned, are you ready for this?
I'm ready.
$857 million pre-tax.
Wow.
So that's pretty good, right?
Yeah, that's not bad. That's not bad at all.
And what does he love about See's? Simple business model, strong brand, minimal capital requirements, just spits out cash.
It's like that box of chocolates you get for Valentine's Day.
Exactly.
Like, people just keep coming back for it.
Same thing every year. People love it.
Yeah.
And it just prints money for Berkshire.
Yeah, and it turns out it's a cash cow for Berkshire Hathaway.
Exactly.
That's amazing.
It really is.
Speaking of cash cows,
Yeah.
Geico, right?
Oh, yeah. Geico. One of the most iconic
Yeah.
acquisitions in Berkshire Hathaway's history.
And it's funny because Buffett was actually fascinated by Geico.
Way back in 1951.
Yeah, like way before.
Thanks for books.
They acquired it, so he was onto something with that one.
Oh, yeah. He saw something special in Geico from the very beginning. And under Berkshire's ownership, I mean, their market share has just exploded, right? They've gone from 2.5% in 1995 to over 11% in 2015.
Wow.
So massive, massive growth.
So their secret to success is low costs, right?
Low cost. And they're very efficient
Right.
operationally.
Like a well-oiled machine again.
Exactly.
Yeah.
They figured out how to offer these competitive prices.
Yeah.
While still being really profitable.
So they're like the Costco of car insurance, right?
Yeah, I like that. Yeah, the Costco.
It's high volume, low prices.
High volume, low prices, and still making good money.
Yeah.
Because they're so efficient.
I love it.
Yeah. And Buffett has said, that low-cost advantage is their moat.
Yeah.
That's the thing that really protects them
Protects them.
from the competition.
Now let's talk about something completely different.
Okay.
Okay. Nebraska Furniture Mart.
Oh, yeah. This is a great one.
Yeah, this one's fun. This is a great example of, Buffett loving these strong
That
local
market,
businesses.
With a very clear competitive advantage.
Yeah. And there's a great story behind it too, right?
Oh, yeah.
Yeah.
Mrs. B, the legendary manager.
Yeah, Mrs. B.
This anecdote where she tells her customers, look, I can sell so cheap
Yeah.
because I work for this dummy who doesn't know anything about carpet.
I love that.
And that perfectly captures, I think, Buffett's,
Appreciation for these really savvy managers
Yeah.
who really know their business
Yeah.
inside and out.
And it also shows his willingness to just trust
Totally.
the expertise of those people on the ground,
Absolutely.
right? Like, he's not a micromanager.
No, he hires the best people
Yeah.
and then he gets out of their way.
And her formula for success, right?
It's pretty simple.
Low cost,
Low cost.
low prices,
Low prices.
massive selection.
Massive selection.
That's it.
That's it. And that's turned the Nebraska Furniture Mart into this powerhouse in the furniture business.
It's really proof that you don't need some like fancy MBA strategy or like a flashy brand
Yeah.
to build a successful business.
Nope.
Right. Sometimes it's just about doing the basics
The basics.
really, really well.
Yeah, better than anybody else.
Yeah.
And that's what they've done.
And that's what they've done. Okay, now, to round out our kind of tour of notable acquisitions,
Let's talk about the big one.
let's talk about BNSF, the railroad.
Yeah.
Now, this one was a little different, right?
A totally different animal.
Yeah. I mean, it's a massive operation.
Huge.
So much capital
Yeah.
intensive, right?
Yeah.
So what drew Buffett to BNSF?
So Buffett, he's always been willing to invest in these large businesses
Yeah.
that are essential to the economy
Right.
and that have this long runway for growth.
Okay.
And BNSF fits that bill perfectly. I mean, it's a vital artery in the U.S. economy, right? Moving goods all across the country. And Buffett, he sees the fuel efficiency and their commitment to environmentally friendly technology as big pluses.
So it's like a bet on the future of transportation,
Yeah,
but also the future of the U.S. economy, right?
absolutely.
Like he's not betting against America.
No, not at all.
Right.
He's betting on America.
Defines long term, where is this all headed?
Yeah.
And how can he position Berkshire to benefit from those trends?
And it's interesting, right? Because the railroad, it's not a sexy business, right? But it's this incredible example
Yeah.
of durable competitive advantage. I
Yeah.
mean, they have massive scale, a critical role in the economy,
Yeah.
and they're committed to efficiency
Yeah.
and innovation.
It's a great business.
It's a great business.
Yeah. So we've seen how his philosophy plays out in these very different businesses.
Yeah.
Chocolate, car insurance, furniture, railroads. It's amazing. It's like he's got this mental model
He does. He's got this framework for
Yeah.
thinking about businesses,
and he applies it
and he can apply it across industries.
across industries.
That does.
Yeah. Now I'm curious, what about the businesses that he just chooses to avoid? Like, what are the red flags that he's warning us against in these letters?
Ah, that's a great question. And this is where we get into his skepticism about Wall Street,
Okay.
right? He doesn't have a lot of love for Wall Street.
Yeah. Well, we'll dig into that
Let's do it.
in just a minute.
Sounds good.
I got to say, it's kind of refreshing to hear someone so successful like Buffett be so skeptical of Wall Street.
Yeah, he definitely doesn't drink the Kool-Aid.
Yeah.
He's got his own way of thinking about things.
It's like he's saying, don't believe all the hype, look beyond those like flashy headlines, think for yourself.
Absolutely. He's all about independent thinking,
Yeah.
not getting swept up in the crowd.
Yeah. And so instead of trying to like time the market or chase those hot stock tips, he's saying
Fundamental.
focus on the
Fundamentals.
fundamentals, the business.
Yeah.
Right. You got to understand the underlying business.
Yeah.
That's what drives everything.
And he's very vocal about certain like red flags.
Oh, yeah. He calls out.
What are some of those?
Well, he often talks about these accounting gimmicks.
Okay.
Right. These like creative ways that some companies use to kind of inflate their earnings or hide true costs.
Yeah.
And, Buffett's a champion of transparency.
Yeah. And honesty in financial reporting.
Right.
Which makes sense, right? Because he's so focused on understanding that true intrinsic value of a business.
Yeah, so he's not just looking at the numbers. He's trying to understand
the story
behind those numbers.
Why behind the number.
Yeah. Are they sustainable? Are they even honest? Right.
Exactly.
It's quality over quantity, it seems like.
Absolutely. And he's also been a big critic of excessive executive compensation, especially when it comes to things like stock options, right?
Yeah.
He believes those are a real expense.
Yeah.
Not just some, accounting magic trick.
Right.
He's very focused on making sure that those things are accounted for properly.
So he's looking for these companies where management is being rewarded
Yeah.
for actually creating value, not just playing like, financial games or
Exactly, yeah.
whatever.
He wants to see real value creation.
Yeah, and that ties back into that shareholder alignment piece.
Absolutely.
That's so important to him.
Yeah, it all comes full circle.
Yeah.
It's all connected.
Now, while we're on this topic of compensation and financial practices, let's go back to something we mentioned earlier, this idea of undistributed earnings.
Oh, yeah. The forgotten but not gone earnings.
Right. Forgotten but not gone. Can you just remind us what that's all about?
Yeah, so this is the idea that, if a company can reinvest those profits
Right.
at a high rate of return, it's often better for them to keep that money and grow the business
Right.
rather than pay it out as dividends.
Yeah.
Right. It's all about compounding those returns over the long term.
So it's like instead of spending your interest earnings, you're reinvesting them
Yeah, exactly.
to get even more.
You let that money grow.
Yeah.
And it can really snowball over time.
Yeah. But that only works if those companies are actually capable of generating those high returns.
That's the key, right? You got to have confidence
Yeah.
in management's ability to allocate that capital wisely.
So it's not just set it and forget it. Right. It's got to be
Active monitoring.
active. You got to do your research.
And that research
Never really ends.
never really ends, right?
Never ends. Right. The market's always changing.
You always got to be kind of reevaluating and making sure the thesis still holds true.
Exactly.
Yeah.
Yeah. You got to be willing to adapt.
Yeah, so dynamic.
Dynamic, not static.
Yeah,
You're constantly learning,
yeah,
evolving as an investor,
yeah.
just like the businesses that you're investing in are constantly changing.
It's a journey, not a destination, right?
It really is. Yeah. It's a process.
Yeah.
And it's a fascinating process.
No, there's one thing that really stood out to me in these letters.
Yeah.
Buffett seems genuinely concerned
Yeah. He's worried.
about finding a successor
Yeah.
who can manage this massive portfolio after he's gone.
Yeah. Well, I mean, he's got a big job, right?
Yeah.
Managing all that money. And even though the board has a succession plan in place for the CEO role, he's really wrestled with this question.
Of who can actually fill his shoes when it comes to making those big investment decisions.
Yeah, he's got this incredible track record.
Decades.
And it's not easy to replicate.
No, not at all.
That intuition, that discipline, that understanding of markets, it's pretty rare.
It's a unique combination of skills
Yeah.
and experience.
Yeah. Well, I think we can learn a lot from him,
Absolutely.
even if we never reach
We can all learn.
his level of success.
Yeah.
Right. And speaking of learning, let's kind of shift gears a little bit
Okay.
and talk about how we can apply some of this wisdom
Yeah.
to our own lives, right?
Yeah.
Because you mentioned earlier that these letters have a lot of value, even for people
Absolutely.
who aren't managing billions of dollars.
I think one of the key takeaways is
Yeah.
this idea of thinking like an owner.
Okay.
Even if you're just starting out
Yeah.
with a small investment portfolio.
Break that down for us. What does that actually mean to think like an owner?
Yeah. I think it means looking beyond that stock ticker and really trying to understand the business, the underlying business,
Yeah.
Ask yourself, if I owned this entire company,
Yeah.
would I be happy with the way it's being run?
Yeah.
Do I believe in its long-term prospects?
Yeah.
Does it fit with my values?
Like that. It's about being more holistic, right?
Yeah.
Not just chasing those gains.
Yeah,
Getting caught up in that market hype.
exactly.
It's about doing your research.
Absolutely.
Understanding the business, making decisions that really align with your long-term goals.
And your values.
Yeah. It's like you're partnering with that company,
Yeah, it's a partnership.
not just betting on its stock price.
Exactly. Yeah, you're in it together.
Yeah. And I think that long-term perspective,
Yeah.
it can be applied to so many other areas of life.
Oh, absolutely. Think about your career, right?
Right.
Are you constantly jumping from job to job,
Right.
chasing that next, shiny object? Or are you really trying to build a solid foundation?
Yeah.
Develop those valuable skills. Position yourself for long-term success.
I love that. It's about playing the long game.
Exactly.
Whether it's your investments, your career, your relationship.
Yeah, it's about making those choices that
Right.
are aligned with your values and your vision
Yeah.
for the future.
Totally. And it all comes back to, what Buffett emphasizes over and over,
Patience,
Patience
discipline.
and discipline.
He's not looking for those shortcuts or the overnight success.
He's willing to wait.
He's willing to wait years, decades even,
Yeah.
for those investments to really play out.
It's like planting a tree.
I love that analogy.
You don't expect to see fruit overnight,
Mhm.
right? You got to nurture it. You got to give it time to grow. You got to be patient. And eventually, if you chose the right tree and you cared for it properly,
You'll have a bountiful harvest.
you get that harvest.
Yeah.
That's amazing. And it's easy to forget that, right?
It is. It's so easy to get caught up in the short term,
Yeah.
the instant gratification.
Especially today,
Yeah.
right? Like the world's moving so fast.
Yeah. Everything's moving so fast.
We're bombarded with information.
So much noise.
So much noise. It's hard to just tune it all out.
It is. It takes a lot of discipline.
Yeah. But Buffett reminds us
Yeah.
that the real winners,
The long game.
they play the long game.
They're the ones who can stay focused.
Yeah.
Tune out the noise.
Okay, so how do we actually do that? How do we filter out all that noise and focus on what really matters?
That's the $1,000,000 question, right? I think it starts with understanding your own goals, your risk tolerance, your investment timeline.
Yeah.
What are you actually trying to achieve with your investments?
Yeah.
Are you saving for retirement? Are you saving for a down payment on a house? Or is there something else? How much risk are you actually comfortable taking? And how long are you willing to wait to see those returns?
Yeah, those are all really important questions.
Fundamental questions.
Yeah, and once you have a sense of those answers.
Then you can start to build a portfolio that reflects your own personal circumstances. And your goal.
But it's not just about answering those questions once and then walking away, right? It's got to be this ongoing
Oh, absolutely. It's a process.
ongoing research, ongoing learning, making sure that what you're invested in still
Makes sense.
makes sense for your
yeah.
goals. Yeah. So it's dynamic, not static.
It's a dynamic process. You're constantly learning and evolving as an investor.
Yeah.
Just like the businesses you invest in are constantly evolving.
Yeah, that's what makes it fun.
That's what makes it so interesting.
Right.
Yeah, absolutely. It's never boring.
It's always changing.
That's for sure.
Now, we talked earlier about how Buffett favors certain industries or types of businesses.
Yeah.
And I'm curious, knowing what we know about his philosophy, what industries or companies today do you think he might be drawn to? What are those moats,
Yeah.
those competitive advantages that we should be looking for when we're evaluating businesses?
That's the key question that I think every investor should be asking themselves.
Yeah.
Where are those opportunities? Yeah. We know Buffett likes these businesses that are essential to the economy,
Right.
and that have this long runway for growth. He likes companies that have these durable competitive advantages,
Right.
predictable earnings, competent management teams. So where do we find those characteristics in today's market?
Well, he's already made a big bet on renewable energy.
Yeah, with Berkshire Hathaway Energy.
Yeah.
Yeah.
So given his long-term orientation and his focus on sustainability, I could see him, I don't know, even more interested in that sector.
Yeah, no, I think that's a great point. Renewable energy is a rapidly growing market,
Yeah.
driven by both, those environmental concerns and the need for energy independence. And there are a lot of companies in that space
Yeah.
that have those durable competitive advantages.
Like those companies developing innovative technologies for solar, wind, geothermal,
Exactly.
or those that are building the infrastructure to support that transition to cleaner energy.
Yeah. Those are the kinds of businesses that could really potentially generate strong returns
Yeah.
for decades to come.
And it fits with his, his belief in investing in things that are solving
Real world problems.
real world problems.
Absolutely.
That's awesome. What other sectors come to mind?
Well, he's always been a fan of consumer staples,
Okay.
right? Those everyday products that people need no matter what the economy is doing.
Yeah. Yeah.
So think about food, beverages, household goods, personal care products.
Yeah.
These are the kinds of things that people are always going to buy.
Right?
And within those sectors, there are companies that have built these incredibly strong brands
Yeah.
and these massive distribution networks that give them a huge competitive advantage.
Right.
They might not be the most exciting businesses, but they can be very profitable and resilient over the long term.
And they generate those, predictable earnings that Buffett loves.
Exactly. Like he said, I'd rather own a part interest in the Hope Diamond than to own all of a rhinestone.
Yeah.
He's after quality,
He's after quality.
not just a quick buck.
Yeah. I
Yeah.
love that.
Yeah.
What about healthcare?
Healthcare. Yeah.
It's a huge industry.
It's huge, massive.
And it seems like that demand is only going to grow as the population ages.
It's only going to get bigger.
Right. So
Sure.
there's got to be some opportunities there.
Oh, absolutely. There are tons of companies in healthcare
Yeah.
that have those characteristics that Buffett looks for.
Like those companies that are developing, new drugs, medical devices, or providing essential healthcare services to a large customer base.
Yeah, and given Buffett's focus on long-term thinking, he might be particularly interested in companies that are focused on preventative care, chronic disease management, or maybe using technology to improve efficiency
Right.
and access to healthcare.
Yeah. And again, solving real world problems.
Exactly, making a positive impact on the
Yeah.
world.
Now, there's one sector that he's been kind of hesitant to invest in
Yeah,
historically, but
but he's warmed up to it.
he's clearly warmed up to it,
In recent years.
which is tech.
Yeah,
Tech.
yeah. It's funny, right? He famously avoided tech stocks for years,
Yeah.
and then he made that big investment in Apple.
And it's been huge for Berkshire.
Huge, yeah.
So what do you think changed his mind?
Well, I think he realized that some tech companies are no longer just these speculative bets on the future,
Okay.
They've become these established businesses
Yeah.
with strong moats, predictable earnings, and competent management teams.
So he's looking for those tech companies
Yes.
that are building sustainable businesses, right?
Yeah, they got to have that long-term vision.
Long term,
Yeah.
not just like a fad,
Right.
a hot new gadget or whatever.
Exactly, yeah. They got to be building something real.
Yeah. And it's interesting because his letters often contain these warnings about the dangers of speculation
Oh, yeah.
and the importance of being disciplined.
Yeah.
So I think those warnings are really relevant today.
Oh, absolutely.
Right. Especially with, we're seeing a lot of like froth and exuberance in certain sectors,
Yeah.
especially tech, right?
Yeah, there's definitely a lot of hype out there.
So how do we avoid getting caught up in that? How do we separate the signal from the noise,
Yeah.
especially in a sector that's so known for its volatility?
Yeah, it's tricky, but I think it goes back to what we've been talking about all along.
Yeah.
Focus on those fundamentals.
The fundamentals.
Look for companies with strong competitive advantages,
Yeah.
predictable earnings, competent management teams. Don't get swept up in the hype.
Right.
Don't chase those short-term gains.
But even in a sector that's moving as fast as tech, his core principles
They still apply.
still apply.
Absolutely.
It's about finding those companies
Yeah.
that are actually building real value,
Yeah.
not just,
Riding the wave.
riding the wave of hype.
Exactly.
Right. Yeah.
They got to have something real underneath.
Now, it's important to remember that even when you're investing in a company with a great track record,
There's always risk.
there's always risk.
There's no guarantees in the market,
Right.
right? That's why Buffett always emphasizes that margin of safety,
Right.
that cushion to protect yourself if things don't go as planned.
Yeah.
Because sometimes they don't.
You never know.
You never know, right?
Yeah. So as we're kind of exploring these sectors
Yeah.
and thinking about these potential investment opportunities,
Yeah,
we got to keep those core principles in mind.
absolutely.
Look for those moats,
The moat.
those durable advantages
Yeah.
that are going to help a business
Throw
thrive
it up
over the long term.
in the long run. Yeah.
Yeah,
That's what we're looking for.
exactly. Now, before we kind of wrap up this part of our deep dive,
Yeah.
I want to touch on one more aspect of Buffett's philosophy
Okay.
that I think is especially relevant
Yeah.
to our listeners. And that's his emphasis on personal integrity and ethical behavior.
Absolutely.
Right.
I mean, his letters,
They're full of
they're
reminders
full of reminders.
about doing the right thing.
Even when it's not easy.
Yeah, even when it's hard.
Right. Like, he believes that integrity is essential,
It's essential for long-term success,
not just in business.
but in life.
Yeah.
Yeah.
And it's not just about following the rules.
No.
Right? It's about having this strong moral compass,
Yeah.
making decisions that are fair,
honest,
transparent.
Yeah.
Yeah.
He's all about that.
And this focus on ethics.
It extends beyond just him, right?
Yeah.
He's very careful about the businesses that he invests in.
Right.
He's looking for companies that share his values,
Yeah.
that operate with integrity.
So it's not just about making as much money as possible.
Got to be the right way.
Right. It's about building this sustainable,
Sustainable, ethical.
business
Yeah.
that benefits all stakeholders.
The employees.
Employees, customers.
Customers, the community.
The community, society at large.
Yeah.
He's very aware of the impact
Yeah.
that businesses have on the world.
And I think that's a really powerful message for all of us.
It is, yeah. Whether you're an investor, an entrepreneur, or just, trying to live a good life.
Yeah. It's about making those choices
Yeah.
that are aligned with your values
And your values.
and striving to make a positive impact on the world.
It's not just about making money.
Yeah.
It's about making a difference.
Yeah.
You know?
I think that's a great note to end this part of our deep dive on.
Yeah, I think so too.
We've covered so much.
We've covered a lot of ground.
We've talked about, those core investment principles, his views on Wall Street, his insights into building those successful businesses.
Yeah.
And I think for you, the listener, I hope this deep dive has given you a deeper understanding of Buffett's approach and how his wisdom can be applied
To your own life.
to your own life, whether you're managing millions of dollars or just starting out with that small investment portfolio.
Yeah. There's something here for everyone.
Yeah. Now, in the final part of our deep dive, we're going to explore some specific steps you can take.
Yeah, practical steps.
Practical steps,
Actionable advice.
actionable advice.
To apply those principles to your own investment journey.
Yeah.
And we'll also delve into some of the challenges and opportunities facing investors in today's market, right?
It's a crazy world out there.
Oh, it is. It's never a dull moment.
All right. So we've spent a lot of time getting into the mind of Warren Buffett, exploring his philosophy, his big acquisitions, his criticisms of Wall Street.
Yeah, we've covered a lot of ground.
But now let's talk about, what can we actually do with all this?
Yeah.
How can we, as individual investors, apply these principles to our own portfolios?
That's the real challenge, right? I mean, it's one thing to sit back and admire Buffett's success, but it's another thing entirely to actually try to put it into practice.
Totally. So where do we even begin?
Well, I think the first step is to really make sure you understand those core principles we've been talking about.
Yeah.
It's not enough to just kind of memorize them.
Right.
You really need to understand the why behind them
Yeah.
and how they can actually guide your investment decisions.
Okay, so let's recap those principles one more time. We've got intrinsic value, margin of safety, long-term perspective, simplicity, shareholder alignment, and of course that powerful concept of float.
That's a mouthful.
Yeah, it's a lot. It's a lot to keep in mind, but how do we translate those kind of abstract concepts into, concrete actions?
Yeah, that's the tricky part, right? So let's take intrinsic value as an example.
Okay.
We know that Buffett is all about buying businesses, not stocks.
Yeah.
He wants to own pieces of companies that are fundamentally sound with durable competitive advantages and the ability to generate those consistent profits over the long haul.
So how do we, as, individual investors, even begin to assess, what that intrinsic value is?
Yeah, it's not easy.
It seems intimidating, right?
It can be, yeah. But I think the key is to shift your focus
Okay.
from the short-term, fluctuations of the market
Right.
to the long-term health of the underlying business.
Okay, so we need to zoom out
Zoom it. Yeah,
and look at the bigger picture,
exactly.
not get caught up in, the day-to-day headlines,
It's the day-to-day noise.
earnings reports, all that stuff.
Yeah.
So what are we looking at? What are the company's, core products or services? Who are their customers?
Yeah.
What are their competitive advantages, right? How sustainable is this business model?
You want to understand what makes that company tick,
Yeah.
what drives their profitability,
Yeah.
and whether they can continue to generate value for their shareholders
Over the long term.
over the long term. And there are tons of resources out there to help you do this.
Okay, like where do we go to find this information?
Well, a good place to start is the company's annual report.
Okay.
That's usually available on their website.
Yeah.
It's like a treasure trove of information about their financials, their strategy,
Right.
their risks and opportunities, their management team.
So don't just like skim the headlines or trust what other people are saying.
Right. Do your own homework.
Go straight to the source.
Straight to the source.
And don't be afraid to like really get in there and dig deep.
Yeah, dig deep.
Look at like, industry reports and analyst research and news articles.
Absolutely.
Get a broader perspective.
It's like being a detective.
Yeah.
Right. You're putting together the pieces.
Piecing together those clues.
Trying to figure out if this company's a worthy investment.
I love it.
Yeah.
Okay, so that's intrinsic value. What about margin of safety? How do we actually apply that in practice?
Yeah. So margin of safety, it's all about buying those businesses at a price that is significantly lower than our estimate of their intrinsic value.
Right. So being a smart shopper.
You're a value investor. You're looking for that bargain.
Yeah. But how do we even determine what a safe price is? Like, how do we know if we're actually getting a good deal?
Yeah, so there are a number of valuation metrics you can use, things like price to earnings ratio, price to book ratio, discounted cash flow analysis.
Okay.
But it's important to remember that these are just tools.
Right.
They're not perfect predictors of future performance.
Right. We're not just plugging in the numbers.
No, you can't just plug and chug. You got to use your judgment.
Yeah.
Consider the specific circumstances of that company, the industry it operates in,
right,
and be realistic about your expectations. And,
right,
the goal is not to find the absolute lowest price, but to find a price that gives you that comfortable margin of safety.
Yeah, it's like that sweet spot.
Yeah.
Where you're getting a good deal, but you're also confident in the long-term, prospects of the business.
Exactly.
Yeah. Now, once we've kind of identified some potential investments, we've looked at that intrinsic value, that margin of safety.
Yeah.
Now we got to dig into the management team, right?
The management team, that's huge.
Yeah.
Buffet, he places a very high value on strong leadership. He wants to invest in companies that are run by people who are competent, honest, and aligned with the interests of the shareholders.
So how do we assess that? How do we know?
Yeah, it's not always easy.
Like, how do we know if the management team's any good?
Well, I think one way is to look at their track record.
Right.
Have they made smart decisions in the past?
Right.
Have they allocated capital wisely? Have they, delivered on their promises to shareholders?
So we're looking for that consistency.
Yeah, consistency, integrity, a proven ability to actually create value.
Yeah. But it's not just about the numbers.
No, it's also about the people.
Right. It's about their character, their values.
Their vision.
The vision for the company, yeah.
Yeah. And that's harder to quantify, right?
Yeah.
But I think you can get a sense of that from things like, shareholder letters, conference call transcripts, interviews with the CEO.
So again, doing your homework, really getting to know these people who are running the business.
Absolutely.
Making sure you're comfortable with them.
You're trusting them with your money.
Yeah.
So you gotta have a good feeling.
And don't forget about that shareholder alignment piece.
Oh, yeah, that's crucial.
Right. Like, how is management being compensated? Are they incentivized?
To think long term.
To think long term.
Absolutely.
Are they building a sustainable business, or are they just trying to pump up that stock price?
Yeah, you got to be careful about that.
Yeah. We want to make sure everyone's rowing in the same direction, working toward that same goal.
Exactly.
Yeah. Okay. And that brings us to another key principle, right? Simplicity.
Simplicity, yeah.
We know Buffett loves those businesses that are easy to understand.
Doesn't understand.
Operate in industries that he knows well.
Yeah, he doesn't like to stray too far from his circle of competence.
Now, obviously, we're not all going to be as brilliant as Warren Buffett.
Right.
But we can still apply this principle to our own portfolios.
Absolutely.
So how do we find those simple businesses? What should we be looking for?
Well, think about businesses that have a clear, straightforward business model.
Okay.
Right? They make a product, they provide a service that people need or want.
Yeah.
And they do it efficiently, profitably.
Right.
They're not trying to be all things to all people. They're focused on what they do best.
So they do it well.
And they do it well.
So we're not looking for the flashiest new tech startup or the company with the most complicated business plan.
Yeah.
We're looking for those solid
solid,
dependable
the
business.
boring businesses.
The boring businesses
Sometimes the boring businesses are the best businesses.
that have been around for a while have a proven track record.
Exactly.
Yeah. And don't be afraid to stick to those industries that you understand.
Yeah, stick to your knitting.
Right. You don't need to be an expert in every sector.
Absolutely not.
Right. Yeah.
Focus on what you know.
Focus on what you know.
What interests you.
What interests you.
Where you feel comfortable doing your research.
Yeah, play to your strengths.
Exactly.
Stay within that circle of competence.
That's right.
Now remember, the goal here is not to find, like, the perfect company
No.
or the guaranteed winner.
That doesn't exist.
There's always going to be some level of uncertainty
There's always risk.
in investing. Right.
Absolutely.
The key is to minimize that uncertainty as much as possible
Yeah, minimize the risk.
by doing your research, being disciplined,
Discipline.
and staying focused on that long term.
the long game.
Yeah. And I think that's where Buffett's long-term perspective is so powerful.
It's incredibly powerful, yeah.
He's not trying to time the market, chase the hot stock. He's just willing to wait.
He's patient.
Be
He
patient.
lets his investments compound over time.
It's a beautiful thing, right?
It is. Compounding is the eighth wonder of the world.
Yeah. And it's about having that discipline to stick to your plan, even when things get tough, knowing that, the market will eventually recover
Yeah, it always does.
and those quality businesses are going to keep growing
In the long run.
in the long run.
Yeah.
So as we kind of wrap up our deep dive into the world of Warren Buffett, what are some final takeaways for our listeners? What can they actually do, with all this information?
Yeah, I think the key takeaway is to remember that investing is a marathon, not a sprint.
Yeah.
It's not about trying to time the market or pick the next hot stock.
Right?
It's about finding those quality businesses,
Yeah.
buying them at a reasonable price, and holding them for the long term.
Patience,
Patience and discipline.
discipline.
Those are the two key ingredients.
Don't get caught up in the hype or the noise.
Tune it out.
Focus on those fundamentals and trust that those quality businesses are going to reward you
They will, in the long run.
in the long run. And you don't have to be an expert, right?
No, not at all.
I don't have to have tons of money.
You can start small
Yeah.
and learn as you go.
There are resources out there
There are tons of resources.
that can help you.
Books, podcasts, websites.
Yeah.
There's no shortage of information.
And don't be afraid to make mistakes.
Oh, everyone makes mistakes.
Everyone makes mistakes.
It's part of the process.
Even Warren Buffett.
Even Warren Buffett.
Right.
He's made plenty of mistakes.
Yeah. The key is to learn from those mistakes.
Learn and keep going.
Keep going.
Don't let it discourage you.
Yeah. And most importantly, remember to enjoy the journey,
Yeah, have fun with it.
right? Investing can be challenging,
It can be.
but it can also be so rewarding,
it is.
both financially and intellectually. It's
Absolutely.
about learning, growing, participating in this exciting world of business and finance.
It's a fascinating world.
And who knows, maybe one day you'll be sharing your own investment wisdom
Yeah,
with the next generation of investors.
that's a great goal.
That's awesome. Well, that's it for our deep dive into the mind of Warren Buffett. Until next time, keep learning, keep exploring, and keep investing in yourself and your future.